Hey, welcome back to Two Super Guys Trade Stocks. I'm Dylan.
And I'm Vinny, and holy crap, when you see a bellwether company like FedEx get destroyed by 20% in a day, you got something you have to pay attention to. And is it a little hint here? Michael Burry did talk about something that kind of hinted at what's going on here. We're going to get to that.
Yeah, this was pretty shocking. If you like this kind of entertaining stock market content where it's two super guys trying to figure everything out, give us a like and subscribe, and hopefully you weren't in FedEx. We'll get started.
Two stupid guys trade stocks.
I mean, I had to, zoom out quite a bit on the chart here to actually get it to the point where everything was like in frame. So this is going back a couple of years on FedEx stock. This is actually the whole COVID crash right
Oh
here.
man, we hit
Yeah,
pre-COVID.
we're getting back to basically pre-COVID levels for FedEx. Now, they did put in like a little bit of a hammer formation, but look at this volume bar compared to like this last several years of volume. Ridiculous, isn't it?
Yeah, that
Yeah,
is
look at that.
disgusting. So I was day trading when this was here, and I didn't even know what to do because I've never seen a fairly blue chip stock just drop this much in one day. I didn't touch it.
Yeah,
I have no
yeah.
idea what's going to happen.
I can't say I blame you. Stand the hell away from this. So this is what happened. They basically pre-announced their earnings. The kind of ironic part here is when you look at this as like kind of top line here, it's like, oh, they still had revenue growth, they were still profitable. It's really when you have to put it in context with analyst reports to really kind of get an idea of like how far off this was from expectation. Like, yeah, sure, their EPS is down a little bit compared to where they were in the same quarter last year, and like I said, the revenue was still up, which is pretty consistent with what we're seeing. So this week was kind of interesting. I was at a quarterly meeting for the group I work for, and you're talking about basically you get brief financial highlights of like a half a dozen different hospital systems, and pretty broadly across the board, we were seeing something roughly similar to this, at least locally here, where we're seeing revenue, close to where we were last year, but at cost of it, exceedingly, run up, and then profit margins have narrowed significantly because of that. And that's basically what you're starting to see here on these, massive bellwether companies as well. So not kind of terribly surprising from my standpoint.
I wonder if this is starting to become a trend because Nvidia did this too, where their
Mm-hmm.
earnings weren't good, and they're like, "Oof, hey guys, just
Yeah.
brace yourself."
Yeah,
It,
yeah. There's an article here. It's gonna a little snippet from an article talk about how far off they were from what actual analyst expectations were, and it kind of falls in line with something we've talked a little bit about before. So this is a chart here of the S&P 500 overlaid with the basically earnings predictions. All right, we've seen earnings kind of flatten out here in terms of their expectations, but they have yet to significantly decline, which is to me makes no sense. Right? Yes, we're headed towards. I'm not like a perma bear, but I'm certainly bearish in the short to
next
medium term as far as the stock market goes
12 to
because we've
18
gotten to these
months.
exceedingly levels. What?
I feel like 12 to 18 months is a solid because I'm not a permanent bear either. It's just I
Yeah,
really don't like the next 12 months.
very reasonable. We're going through a phase of quantitative tightening. Your interest rates are going up. You're taking this excess liquidity out of the market. People talk about supply chain stuff still. A lot of this is really demand driven, is the way I'm looking at this. There's the steal line from the movie Gone in 60 Seconds. There's too many self-indulgent wieners in this town with too much bloody money.
Oh, I love that movie.
It's a good
That's such
movie.
a
It's
good
great
movie.
Nicolas Cage behind. But this is actually a quick tweet over here from Michael Burry where he talked about this a little bit about how we'd had a rough start to the year. This is actually from like June 30th here. How and when you inflation adjusts, that certainly the stock market was down significantly at the beginning of this year, but that was just multiple compression. We were just coming back to a more reasonable multiple. Honestly, still kind of elevated from a multiple compression standpoint, but that's my own personal opinion. Next up, earnings compression. That was what he was saying. Is like you're going to start seeing these companies that are not able to deliver, the earnings aspect of this to justify, even the current decreased multiples. That's what we were
Okay.
seeing here.
You went back for this one. That was June 30th. Look at you.
Yeah,
You,
so,
you
well, we
Burry
had actually talked
historian.
about it at the time. I know, right? Definitely becoming an expert on his tweets and knowing what's out there. Remember, remember this slide? I actually did this in a previous video. The basic comparison here is looking at what the earnings were from like peak to trough in terms of S&P 500 earnings on a few previous market
Like
drawdowns or
big
bear
crashes.
markets. Yeah, crashes. Well, yeah. So you are looking at, for the most part, 24, 30% or so in decline, with the exception of the 2008 crash, where financials were a big portion of this. A lot of that money basically didn't actually exist, if you
Yeah.
would look at it from that standpoint. Um, but when you look at what analyst expectations were and where FedEx came in, their revenue, I mean, their profit here was 33% below the average analyst estimate. Not
Okay.
terribly far off where
Well,
those previous kind of peak to trough we saw, but this is a much shorter time frame than
yeah, I
we
was
had
gonna
seen previously.
say that would mean peak to trough. We're already gonna turn around here. This seems way too soon.
Yes. I didn't actually include here that timeline, but if you can look at the
Yeah, two
dates here,
years.
basically, where you're seeing, most of these things are a year or two that it took, in terms of their peak to trough. So we still have a fair amount of time if it is in line with historical contraction periods as far as EPS. Um, you know, when we talk about kind of what's driving this increased cost, obviously there's a kind of a labor cost price that's hard to compete with right now. My industry is a little bit unique, in that we have significant barriers to entry. So our elevated labor costs are predicted to be significantly higher over a period of time. There's like I said, can't have this influx of people into it.
Right.
But FedEx drivers is probably not quite exactly the same kind of, in terms of that barrier to entry.
Fair. Yeah.
Oh.
Oof.
And yeah, don't forget this. So this right here is the Fed funds rate. If you want to slide
Let me
yourself over there.
move my
Um,
face here.
yeah, exactly. So we're expecting another rate hike this week. Anytime you're seeing these increasing rate hikes here, these followed by a period of recession. That's what these gray bars indicate.
Not
So not
according to the government. We're going to not have a recession because the
yeah,
labor market's good, apparently. And yeah, we're going to increase rates. No recession, even though it's happened every single time in history. But not this
yeah,
time. This time's different.
no, yeah. Just look up, right? Or don't look up. That
Don't
was
look
that was the
up.
name of that movie. Yeah. The other thing too is, like, when we're talking about market valuations here. This is the Buffett indicator. Basically, you're looking at stock market value compared to the gross domestic product of the U.S., and we're still well above the historical trend line. 167% of the normal ratio, following the historical trend line. It's one standard deviation, if you remember statistics at all, meaning we should be within that realm for about 68% of the time. So we're still on the teetering end where we're a little bit above average, and we have a lot of headwinds as far as Fed funds rates. We have the kind of recession that a lot of company earnings are starting to indicate we're headed towards. And yet people are still paying these exorbitant valuations for these companies. So, like I said, I'm not definitely not a perma bear, but I think we need to regain something a little bit more reasonable for our stock market multiples and the earnings underlying these companies before we can have another phase of expansion.
Yeah, I wonder if, like I said, Nvidia did this too. I wonder if there's any strategy for the company on they know it's going to be a bad week because we're literally downtrending the last 2 days. So, like, hey, it's going to be a bad week. Let's release the
Yeah.
news already. And then hopefully when the news comes out, it's like a good week and they can regain some losses. I wonder if there's any strategy like that
Yeah.
for the company. Because Nvidia also did it on a very bad overall week.
Yeah, it's a good thought. Actually, that's not something I considered. I will tell you that we will get a little bit more color because they still have their earnings call, which is scheduled. I think it's like this week on the 20th, I want to say. So we'll get a little bit more color on actually what they were sawing on a more granular level once we start. This would be a fun one to listen to. You're probably gonna get some great analyst questions like, "Why did your stock drop 20% in one day? Like, what are you gonna do?"
Yeah, this is. I'll listen to this one. This one sounds pretty good.
Yeah,
Well,
certainly so. Yeah.
all right,
Let us know
dudes.
what you think. Yeah.
Yeah,
Does this bode poorly for the economy as a whole?
I'm gonna say yes. Let us know what you think. This was, like I said, this does not happen that often to have, this safe of a company drop 20 crazy percent or whatever it was. All right,
Yeah.
dudes.
See you in the next one.